1999. Warren Buffett just delivered the worst performance of his entire career, 0.5%. While the S&P soared and tech stocks exploded 300%, Buffett's shareholders watched their portfolio sit dead in the water. Financial media wrote obituaries for his career. But here's what nobody understood. Buffett was engineering one of the greatest comebacks in market history by refusing to play a game. He couldn't win. Today you'll learn the three-part discipline system he used to survive maximum pressure. Same framework that turned short-term humiliation into long-term domination. Drop a comment right now. What's your biggest fear when your portfolio underperforms? Let me paint the picture of what Buffett faced. The year is 1999. The Nasdaq has tripled in 18 months. College kids are day trading and making more money than doctors. Pets.com goes public at $82 a share. Company that loses money on every sale but promises to make it up in volume. Every financial channel, every newspaper, every dinner party conversation says the same thing. This time is different. Technology has created a new economy. Old valuation. Rules don't apply anymore. And what does Warren Buffett do? Nothing. He sits on $28 billion in cash while everyone around him gets rich. His shareholders are furious. They're watching neighbors who bought Yahoo make 10 times their money in 6 months. Meanwhile, Buffett owns Coca-Cola, which is down. He owns Gillette, which is down. He owns American Express, which is down. Everything in his portfolio is yesterday's news. The amateur's instinct in this moment is clear. You're wrong. The market is telling you you're wrong. Your shareholders are telling you you're wrong. The media is telling you you're wrong. You need to adapt. You need to evolve. You need to buy some Microsoft before you become irrelevant. But Buffett's 1999 letter opens with these words. Even Inspector Clouseau could find last year's guilty party, your chairman. He takes full responsibility. No excuses about market conditions. No blaming tech stocks. He grades himself a D in capital allocation. But here's what separated him from the 97% of fund managers who would lose everything in the coming crash. He admitted failure while maintaining discipline. Think of it like a general facing criticism for refusing to attack enemy territory. Your troops question your courage. Your advisors question your judgment. But you've studied the terrain, and you know that territory is a killing zone. You don't have the weapons to win there. The professionals who survive wars aren't the ones who fight everywhere. They're the ones who know exactly where they can win, and defend those positions with ruthless discipline. Buffett was fortifying 3 defensive positions. 3 principles that would save him when the market imploded 18 months later. Principle number 1. Know your killing zone and stay in it. This was Buffett's first and most sacred defensive position. In military terms, terrain determines tactics. If you don't understand the battlefield, you've already lost. Now pay attention to this next part. Your circle of competence is the narrow field where you have genuine expertise that gives you an edge over other investors. Not interest. Not enthusiasm. Not I read some articles. Expertise. The ability to predict which companies in that field will have durable competitive advantages 10 years from now. Think of it like warfare. You don't send infantry into naval battles. You don't send cavalry into urban combat. You deploy forces where they have overwhelming advantage. Buffett's advantage was in stable, predictable businesses with strong brands and pricing power. Technology. In 1999 was rapidly evolving patents, network effects, winner-take-all dynamics. That was enemy territory. Here's where most traders go wrong. They see opportunity outside their expertise and think, I can learn this. They start reading. They study the companies. They feel smart because they now understand the jargon. But understanding what a company does is completely different from predicting which company will dominate in a fast-changing field. venture capitalists who work 80 hours a week in Silicon Valley, who have engineering degrees, who understand technology architecture. They're all competing to identify future winners. 90% of them pick wrong. So what makes you think reading some analyst reports will give you an edge they don't have? The amateur says, I'm missing out. The professional says, that's not my game. Buffett stated it directly in his 1999 letter. Our problem, which we can't solve by studying up, is that we have no insights into which participants in the tech field possess a truly durable competitive advantage. The professional does something different, and it requires iron discipline. Buffett developed a strict rule. If he couldn't explain a company's competitive advantage to a 12-year-old in under 2 minutes, he wouldn't invest. This required acknowledging that huge opportunities would pass him by. Microsoft was compounding at 40% annually. Amazon was being born. Google would launch the next year. He didn't care. Think of it this way, a master chess player doesn't try to become a master poker player just because there's a big poker tournament. Different games require different skills. Buffett wasn't interested in what he might learn. He was focused on deploying capital only where he had proven expertise: consumer brands with pricing power, insurance economics, simple, predictable businesses. Let me show you this in action. And the numbers are staggering. In 1999, Buffett owned 0 tech stocks, 0. His biggest holdings were Coca-Cola, American Express, Gillette Company's analysts called dinosaurs. These stocks went nowhere while the Nasdaq tripled, but watch what happened next. From March 2000 to October 2002, 30 months, the Nasdaq crashed 78%. Pets.com went bankrupt. Webvan collapsed. Hundreds of internet companies vaporized. Trillions of dollars in market value destroyed. Buffett's dinosaur portfolio? Mostly unchanged. Why? Because Coca-Cola's competitive advantage, global distribution, brand loyalty, pricing power hadn't changed. People still bought Coke. Gillette still had 70% razor market share. The tech investors who mocked Buffett in 1999 for not getting it lost everything by 2002. Buffett's circle of competence, boring, predictable, moat-protected businesses, didn't make him rich in the bubble. But it kept him rich after the crash. That's the power of knowing your boundary. You don't capture every opportunity. But you also don't get slaughtered in territories you don't understand. But staying in your circle means nothing if you don't know how to recognize quality within it. Because even inside your expertise, 90% of businesses are mediocre. That brings us to Buffett's second defensive position. Principle number 2. Only fight from fortified positions. In warfare, terrain with natural defenses, mountains, rivers, fortress walls, let smaller forces defeat larger ones. In business, that fortress is called pricing power. It's the ultimate competitive advantage. You're going to want to write this down. Pricing power means a business can raise prices without losing customers. This single characteristic separates wealth compounding machines from value traps. When inflation hits, when costs rise, when competition arrives, businesses with pricing power pass costs to customers and maintain margins. Businesses without pricing power get squeezed to death. Think of it like fortified territory. A castle on a hill can withstand siege. A camp on flat ground gets overrun. Buffett hunts for economic castles, businesses so valuable to customers that a 10% price increase doesn't drive them away. Here's the trap that destroys retail investors. They see a company with low prices and assume that's an advantage. This airline has the cheapest fares, they'll steal market share. Or, this retailer undercuts everyone, they'll dominate. But low prices aren't a moat. They're a weakness. It means you're in a commodity business where customers only care about price. The second a competitor goes lower, your customers leave. You can't raise prices because you'll lose everyone. How do you build wealth when you can't raise prices, but your costs keep rising? You don't. The amateur sees cheap current prices as strength. The professional knows that without pricing power, you're fighting on indefensible terrain. One bad quarter, one new competitor, one cost spike, you're finished. The professional asks one question, and it changes everything. Buffett developed a simple test. If this business raised prices 10% tomorrow, would customers leave or would they grumble but pay? If they'd leave, it's not a great business, no matter how cheap the stock. If they'd pay, you've found a fortress. This required patience most investors lack. Pricing power businesses trade at high multiples because everyone recognizes their quality. 25 times earnings seems expensive. But Buffett knew buying a castle at a fair price beats buying a tent at a bargain price. The castle withstands storms. The tent gets blown away. His rule: pay reasonable prices for businesses that can raise prices. Ignore bargains that can't. Let me show you the math. It's devastating for those who don't understand this. In 1972, Buffett bought See's Candies for $25 million. Analysts said he overpaid. It was multiple times book value, which seemed crazy for a candy company. But Buffett saw pricing power. See's wasn't selling candy. It was selling tradition, mothers buying for daughters Christmas gifts, Valentine's gestures. That emotional connection meant See's could raise prices 5 to 10% annually without losing customers. By 1999, 27 years later, See's had generated $857 million in pre-tax profits from a $25 million investment. That's a 34 times return. And it required almost no additional capital because the business generated so much cash. Buffett noted in the letter that Chuck Huggins, See's manager, achieved something remarkable. When he took charge at age 46, the company's pre-tax profit in millions was about 10% of his age. At age 74, that ratio hit 100%. The fortress kept getting stronger. But here's the problem. You can identify great businesses with pricing power all day. If management doesn't care about shareholders, you'll still lose. That's where Buffett's third defensive position becomes critical. Principle number 3. Only fight alongside commanders who have skin in the game. This is where most people get it wrong when evaluating stocks. In military terms, mercenaries fight for money. Patriots fight for their homeland. One will flee when the battle gets hard. The other will die defending the fortress. Owner-operators are managers who made their fortune building the business and work because they love it, not because they need the paycheck. They have millions of their own money invested, not stock, options, actual cash purchases. They've run the company for decades. They make decisions for 10-year outcomes, not 90-day earnings calls. Think of it like generals who own the land they defend versus hired commanders who rotate through every 3 years. One protects long-term value. The other maximizes short-term performance to get promoted. Want to know how most investors evaluate management? They read the CEO bio, see impressive credentials, Harvard MBA, Fortune 500 experience, visionary leader, and assume that means quality. Or they look at stock option packages and think, management is incentivized. But hired executives with big option packages are playing a different game. They maximize metrics that boost the stock price in their 3 to 5 year tenure, collect their options, then move to the next company. They risk shareholder money, not their own. They acquire competitors to show growth, even if the deals destroy value. They hit quarterly numbers by cutting investment in the future. The amateur trusts credentials and compensation packages. The professional asks, how much of their own money is in this company, and how long have they been here? Buffett developed a radical approach, and what happened next proves why it works. He buys businesses from owner-operators, but never requires them to stay. No employment contracts, no golden handcuffs. He tells them, run this business exactly as if you own one. 100% of it. Then he gives them complete autonomy, no budgets to approve, no headquarters oversight, no quarterly reporting requirements. Why would independently wealthy people keep working under those terms? Because they love the business. And people who work for love, not money, build better companies than people chasing bonuses. They obsess over product quality. They build for decades. They treat customers like family. Buffett's rule. Partner with owner-operators who'll still show up if you stop paying them. Let me tell you a story that proves this principle. It's one of the most remarkable in business. In 1997, Bill Child ran R.C. Willey, Utah's dominant furniture retailer. He wanted to expand to Boise, Idaho, but he had one non-negotiable principle. R.C. Willey never opened on Sundays for religious reasons. Buffett was skeptical. How do you compete against stores open 7 days when you're closed on Sunday? Biggest shopping day? Here's what Bill Child did. He personally financed the entire $9 million store himself. His offer to Buffett: if it succeeds, I'll sell it to you at my cost with 0 interest on the 2 years I had capital tied up. If it fails because of my no Sunday policy, I absorb the entire loss. You owe me nothing. The store opened in August 1999 and immediately became a huge success. Bill Child handed the property to Berkshire at cost, refused to take a dime of interest, and personally bore all the risk. Now ask yourself, would a hired executive making $3 million a year ever do that? Would they risk $9 million of their own money for a principal? This is the difference between mercenaries and patriots. And it's why Buffett says owner-operators like Bill Child make him tap dance to work every morning. Let's bring this complete defensive system together, because separately these are good ideas, but combined they're a fortress. Buffett's 1999 survival strategy wasn't any single rule, it was the integration. The 3-position defense that let him withstand maximum pressure. It begins with circle of competence, ensuring you only fight on terrain you understand deeply. You know the weapons. You know the tactics. You know which positions are defensible and which are traps. It moves to pricing power, ensuring you only occupy fortified positions. Economic castles with moats that competitors can't cross. Businesses that can raise prices when costs rise, meaning you control the battlefield. It demands owner-operators, ensuring your generals have skin in the game. They're defending their homeland, not collecting a paycheck. They make decade-long decisions, not quarter-to-quarter trades. This is not a stock-picking pattern. It's a mental discipline. Here's what this really means for you right now. The 90% who fail chase every hot stock, own businesses they don't understand, and trust hired executives with fancy credentials. They're driven by FOMO. They see a stocks up 100% and think, I'm missing out. They abandon quality businesses because the stock price isn't moving fast enough. The 10% who succeed operate from this defensive system. They have cultivated the discipline to say no to opportunities outside their circle. They see the same AI hype and ask, do I understand this better than full-time venture capitalists? When the answer is no, they pass. The system transforms speculation from gambling into investing. It protects capital during manias, and it positions you to buy quality assets when the inevitable crash arrives. Now let me be clear, and this is critical for your portfolio right now. This is not easy. Buffett himself said in the letter, our lack of tech insights does not distress us. It took supreme confidence to admit limitations while being mocked on every financial channel. This system will not make you rich next month. What it will do is prevent you from getting destroyed in bubbles. But only if you have the discipline to watch others get rich in territories you don't understand, and smile knowing you're defending fortified ground. Most won't have that discipline. Will you? So here's my challenge to you right now. Go through your current portfolio tonight. For each stock, ask 3 questions. Is this in my circle of competence? Does this business have pricing power? Is management an owner-operator or a hired gun? Don't just watch this video and do nothing. Buffett spent 18 months enduring humiliation to learn these lessons. You just got them in 13 minutes. The question is, will you apply them, or will you be part of the next bubble casualty list? If you're serious about understanding Buffett's complete methodology, read his 1999 annual letter, full text, linked in the description. This isn't theory. It's battlefield wisdom from surviving the worst year of a legendary career. And for those who want to see how these three principles apply to 2025's overvalued AI stocks and elevated market, watch this video next, where I break down the specific warning signs. If this changed how you think about circle of competence and pricing power, smash that like button. Subscribe for more deep dives into legendary investor strategies that actually work, and drop a comment. Which of these three principles, circle of competence, pricing power, or owner-operators, was most eye-opening for you? I read every comment. Remember, this video is for educational purposes only. This is not investment advice. Buffett's strategies require study, practice, and discipline. The 1999 bubble proved that even the best investors face years of underperformance. Always do your own research and never risk more than you can afford to lose.